Hello everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. Many thanks to our current Patreon supporters for making this video possible, and we would also greatly appreciate if you consider supporting us as well, so please check the link in the description for more details. My name is Seva, and today we're going to investigate arbitrage on futures markets and how you can identify potential arbitraging opportunities between spot and futures prices and make yourself some riskless profits. And we will be heavily building up on the two cases of long and short futures trading that we have investigated in previous videos. So if you are mainly interested in margining with futures trading and how to calculate payoffs and all of these sort of things, please check those videos out first. But without further ado, let's start investigating the arbitraging model on futures markets. Our first case involves a hedger, that is a manufacturing company that is heavily exposed to oil price being a key component in their costs, and they decided to reduce their exposure to oil, or to eliminate it perhaps even in the best case scenario, by entering a long futures contract on the 30th of September 2020, maturing at the end of November 2020. And they have eliminated their exposure for 10,000 barrels of oil, meaning that as the contract size is 10,000 barrels, they bought 10 futures contracts. And it's all fair and square, and obviously we could see how the futures price evolves throughout the time and calculate contract payoffs using the simple formula relating the current futures price to the start futures price and multiplying it by the total size of our position. And here obviously it is important to note that as you are long on futures, you gain if the price increases beyond what you have agreed upon at the start, and you lose when the price falls down. So here, for example, we can see that on the 1st of October 2020, we are notionally losing $13,000 because of foregone upside, as we have fixed our oil price at which we would effectively buy it at the end of the period at $42.75 per barrel, and we could have agreed for a better deal, buying it for less. And this is how the contract payoff can be calculated straight away, and we can see that our ultimate contract payoff is actually positive, and it's $48,400 as the futures price at the end, and the price that we would have paid if we were not entering any futures contracts, if we were not using derivatives, would have been much higher, the price that we would have paid. So it means that overall we have guaranteed ourselves some decent upside given how prices evolved throughout the lifetime of the futures contract. But can we do any better? Could we have perhaps altered our hedge somehow in the middle of the period, arbitraged on the markets and guaranteed us a better payoff? Well, to investigate that, we have to first learn what this equation means, and this equation is a key component of the identification of whether an arbitraging opportunity exists. And on the left hand side we have got the spot price plus the present value of net holding costs for the underlying asset. Here it would be our commodity, Brent crude, isn't it? And on the right hand side we have got the present value of the futures contract, so the value of the money we would have paid for the futures or would have received if we shorted the futures, accounted for time value of money considerations. And this equation straight away tells you why it's not as easy as just comparing the spot price to the futures price today and seeing that if they're different there is an arbitrage opportunity. Because obviously, as we have already spotted during our previous videos, there is a notable gap between spot prices and futures prices that starts quite wide before the futures mature and slowly narrows down as the maturity date approaches. And the reason for this gap existing is simply because holding spot until the very end could be quite costly, as first of all you need to pay up your cash straight away on the spot market and not at the end of the period when the commodity is to be delivered to you. as per the futures contract, but perhaps most importantly, if you own this commodity as you bought it from the spot market previously, you have to account for storage costs, insurance costs, and so on and so forth, or perhaps even transportation costs, that type of thing. So this consideration is what accounts for this gap first, and as time goes on, and as the maturity date approaches, the impact of holding costs and the impact of the time value of money considerations decrease steadily with time, and this is why the futures price and the spot prices converge almost perfectly at the end of the period when the maturity date is upon us. But how to express it mathematically, and most importantly, which assumptions are we using to explain the arbitrage and opportunities using this equation? Well, first of all, we need to make sure that there is liquid trading in both the spot market and the futures markets, so we can trade both without any concerns. Second, we need to make sure that short selling is enabled and not restricted or banned outright for either the spot or the futures, and this is mainly revolving around some legal or regulatory frameworks that might be in place. For example, if you look at stock markets, in the UK quite notably, short selling of stocks was banned from the heyday of the 2007-2008 financial crisis, and this ban has been lifted only in 2017. So you need to make sure that you actually can short both futures and the spot for this arbitrage identity holding true. Also, for some futures contracts, the underlying might not be tradable at all. For example, weather's futures has been quite prominent throughout history for hedging the risk of agricultural companies, and you can buy and sell weather futures, but you cannot really buy or sell weather on the spot. That's not how it works. So for these types of futures, arbitrage would also be impossible. What we also assume is that holding costs are clearly measurable and we can know them in advance, so they are not uncertain, that is. And we also require the assumption of perfect capital markets. Perfect capital markets is quite an unrealistic and stringent, but very common assumption that is made in a wide range of finance models, this one included, to simplify the derivation and calculations. The logic of the perfect capital markets assumption requires anyone, any agent, to be able to either borrow or lend money indefinitely at the risk-free rate. So the interest rate for everyone is equal and is equal to the risk-free rate, and you can borrow or lend money indefinitely. So there are no such liquidity or default risk concerns that would prevent that. The easiest way to explain how unrealistic this assumption might be is that if the perfect capital markets assumption holds true, you could go to your bank and ask them to lend you $1 billion at 0.89% per annum, and the bank would agree, which obviously is not the case in the real world. But again, even though this assumption seems really unrealistic, it doesn't make much difference, turns out, and that is why it's quite heavily used in all areas of finance. And finally, we need to account for the fact that the impact of transaction costs, so brokerage fees and bid-ask spreads, is negligible, so this equation would hold true without any friction. So if we identify a mismatch between the two sides of the equation, arbitrage can be executed, while in reality, if you account for brokerage fees or bid-ask spreads, there is some margin of error that this equation can allow before arbitrage opportunities will exist. This out of the way, the idea, the main concept that allows you to generate such an equation is the idea of a replication strategy. Well, what is the outcome, the ultimate goal of longing a futures contract? Well, it is to be left with a certain amount of barrels of oil, in that case, at the end of the period, end of October 2020. How you might achieve the same ultimate outcome without using the futures markets? Well, it's quite easy, isn't it? You can just buy oil at the spot straight away and just hold it until the maturity date, and then pretend that the maturity date is actually when you have received the oil. So you buy the oil on the spot straight away, forget about it for some time, and then at the end of the period, you just take it out and imagine that you've just got it from your futures contract counterparty. So both of these approaches would yield equivalent results at the end. And that means that this spot strategy, buying oil at the spot and holding it until the maturity date, is the replication strategy. And that's what allows us to assume that the payoffs of both strategies should be equivalent. And if they are not, and provided that all of the assumptions I was discussing before hold true, we can use this equation to detect arbitrage opportunities. So without further ado, let's do that. First of all, we have to account for time value of money considerations. And here we can calculate the discount factor by using the simple logic of continuous compound interest rates. We, first of all, check how much time would have passed from the start date until the date we're interested in. So this difference shows you how many days are passing between 30th of September 2020 and the present date. Then we divide it by 365 to convert it to annual frequency. And then we just convert the annual risk-free rate of 0.89%, which is quite a representative risk-free rate for present times, into this frequency. And then we divide 1 by this 1 plus discount rate to get our discount factor. Quite simple and easy. And we can see that at the start our discount factor is 1 because no time has passed yet, but later on our discount factor slowly decreases, accommodating the time value of money considerations. For example, at the very end, at 30th of November 2020, our discount factor is 0.9985. And obviously the time value of money considerations would be more prevalent if the risk rate was higher. Right now, the risk rate is quite low, so this concern is not that important, especially for short-term futures trading. But if we imagine that it was, for example, 20%, then the discount factor, even over 2 months, would be quite noticeable and material, yielding 0.97 of a discount factor 30th of November 2020, meaning that $1 30th of September 2020 would have been equivalent to only 97 cents at the end of November. But returning back to reality, turning our risk rate into 0.89 again, we can still see how money in the future is less valuable than money in the present, with $0.9985 30th of November 2020 being equivalent to $1 30th of September 2020. Then we need to account for holding costs somehow, and here we can make an assumption that we already know what the holding costs are. For example, rent for the storage of oil, and we assume that first of all the holding costs, the storage fees, for example, are payable upfront, and they are $0.05 per day per barrel, so 5 cents per day per barrel of storage. And then we can calculate the holding cost if we have bought the spot at a particular day by using this simple logic. First of all, we figure out how many calendar days we would have needed to store oil for from the date when we buy oil, 30th of September 2020 here, until the very end date, until the maturity date of 30th of November 2020. Then we need to multiply it by how many barrels do we need to store, 10,000 in that case, and multiply it by the fee per day per barrel, 5 cents per day per barrel in this case, so $0.05. And here we can see that if we want to store our oil for 2 months, we would have needed to pay more than $30,000 upfront for storage, and this slowly decreases as we need less and less time to store it as we go further and further into the lifetime of our futures contract. Then we can calculate the left-hand side of our equation, of our futures valuation model, by accounting for both the spot price and the net present value of holding costs per barrel. So here we add up the spot price in dollars per barrel and our holding cost per barrel, so holding cost over the number of barrels, and multiply it by the adequate discount factor that is prevalent at the current time. And this would be the left-hand side of the equation. Now we can consider the right-hand side of the equation, and here we just need to adjust the futures price by the discount factor at the very end. And this would not change, as for futures trading, you are always exchanging cash flows at the maturity date, because for spot prices you need to account for time value of money considerations as of the date of transaction, but for futures trading you always exchange cash flows at the very end, so the discount factor is always this. And now we can calculate the difference between the two, figuring out whether the spot is overvalued or the futures is overvalued. And given the fact that here our difference is positive, meaning that the spot is overvalued in relation to the futures, you could have arbitraged if you were just an plain arbitrageur approaching the futures markets and the spot markets from this angle. You could have short sold the spot and longed the futures and locked in a quite decent risk-free profit. This corresponding to the net present value of the risk-free profit per barrel of oil. But if we recall that our case involves a hedging counterparty initially, and they have longed the futures contract already, we need to figure out at which point in time, if any, we can beneficially do the transaction the other way around. If we can do the arbitrage based on shorting the futures and longing the spot, given the fact that this accounts for our business needs and this accounts for the hedges we have already got in place. We have already got a long hedge in place, so we need to figure out whether we can profitably unwind this hedge by just cancelling it out with a short futures contract and then just longing the oil we need at the spot and holding it until the date we need it, the maturity date 30th of November 2020. So let's see if this difference becomes negative at some point. Negative difference being the identification of an opportunity to profitably short sell the futures and long the spot. So here we can see that the first day when this difference becomes negative is 9th of November 2020. Here we can see that the spot is undervalued with relation to the futures price. So at that stage we can unwind our current hedge, the hedge being the long futures in oil. So we just short sell the futures in oil at the current prevalent market price, and immediately we also buy oil at the spot and hold it until the very end. So let's account for this and calculate all of the cash flows that would be associated with this arbitraging strategy. So we need to long the spot, so it means that we need to buy 10,000 barrels of oil at the market price, at the spot price on the 9th of November 2020, meaning that we need to pay up, and this would be immediately on the 9th of November, isn't it? $412,300. We also need to pay the holding costs upfront, referring to the holding costs calculated as of 9th of November. But here the problem is that we need to get this cash somewhere. Well, because this is the concern that we do not have in the futures contracts. In the futures trading, we would have needed to pay for the oil at the very end of the period. So here we need to provide for both the spot price, so buying oil on the spot, and the storage costs immediately on the 9th of November 2020. So on the 9th of November 2020, we need to take out a loan that corresponds to $422,800, and we need to pay interest for this loan, taking into account the loan principal and the maturity of the loan. And here the loan would be quite short term. It would just be 21 calendar days, isn't it? Because we take it out 9th of November and repay it 30th of November. But still, to account for present value of money considerations, and that's where it comes into picture physically as payoffs, as cash flows, we can calculate the amount of interest that we would have needed to pay to facilitate that loan. And it would be $216 of interest. That would be accounted with a negative sign, with a minus sign, as this is something we need to pay up. Then, at the very end, we would have accounted for our initial hedge, so we would have honored our initial contractual obligation by buying 10,000 barrels on the futures markets, so paying $427,500 for our initial futures contract. But given the fact that we shorted futures on the 9th of November, we would have also received $42.4 per barrel for the 10,000 barrels, meaning that this effectively cancels our initial hedge, and we can stick with the physical oil we have bought at the spot 9th of November. And here we can just sum up all of the payoffs and arrive at $426,516 that we would have needed to pay to guarantee 10,000 barrels of oil at the end of the period. And if we compare it to the payoff of the initial strategy, just long in the futures as of 30th of September, we can see that such a payoff would be smaller. We would have gained $984.4 for the whole contract if we arbitraged compared to the instance where we didn't arbitrage. Reinforcing the same logic for the short futures trading case, we can first of all see that we need to look at the inverse relationship between the left-hand side of the equation and the right-hand side of the equation. Why is that? Because in that case, as we are an agricultural company that tries to reduce or mitigate its exposure to wheat prices, we shorted the futures for wheat initially, meaning that our standing hedge is a short futures. So we need to figure out whether there is an opportunity to profitably unwind our hedge by longing the futures and short selling our wheat at the spot, meaning that the assumption here is quite a little bit more stringent than in the previous case. We also need to assume that first of all our commodity is available to short at the spot market throughout this period, which might not be realistic, so we need to account for that, and also that the holding cost component of our commodity evolves like that. So there is some storage costs payable per day per bushel, just as it was with oil. And obviously for oil it is very realistic, but for wheat for longer time periods it might not be as realistic, because if you store wheat for 20 years, for example, you won't have much of a usable product left at the end of the period, perhaps, because, well, agricultural products do spoil, they do expire, they do rot, if you speak plainly. But across 2 or even 3 months periods, you can assume that wheat would not rot or expire, or nothing terrible would happen with it, so we can stick with our initial assumptions. And here we can see how this difference evolves through time. We can see that, to start with, the spot market is undervalued with regards to the futures markets, so we made a good decision initially, I guess, to short the futures and not short the spot. But as the situation evolves, we can see that here on the 2nd of December 2020, we have got our first case when the difference flips, when the spot price becomes overvalued with regards to the futures price, when holding costs and time value of money considerations are accounted for. And that means that 2nd of December 2020, we can start arbitraging. And here it just goes the other way around, because as we sell the spot 2nd of December 2020, so means that we receive that much for our 70,000 bushels of wheat, we also save up on the holding costs, so we actually cancel our storage and get back the money that we have paid. So here we can see that this $840 that we would have needed to pay if we stuck with the futures contract are now free for us to use any way we want. And it means that we can deposit the proceeds from shorting the spot and saving on holding costs within the bank and earn the risk-free rate for our deposit period. And the deposit period is again quite short. It's just 12 calendar days, isn't it? From 2nd of December 2020 until 14th of December 2020, but still we make $118 of interest. Then we need to account for the fact that we have unwinded our initial hedge, meaning that we short our initial futures at 5.78, and we also long the futures on the 2nd of December, and here is just a coincidence that futures prices at the start of the period, 30th of September, and at our arbitrage date, 2nd of December, were identical, so these payoffs are the same in magnitude but different in signs, obviously. And here we can account for the fact that we have got a very complicated payoff structure in this arbitrage case, so we add up all of our payoff components, so the short selling of the spot, savings on holding costs, interest that we have earned from depositing the proceeds, and also the payoffs from 2 futures transactions, longing the futures on the arbitrage date and shorting the futures on the start date, 30th of September. And here we can say that our total payoff, so the amount of money we have generated from selling 70,000 bushels of wheat, is $406,258. And if we compare it to the proceeds we would have received if we stuck with the original short futures contract, we would have just received $404,600 for the whole bulk of wheat, meaning that our arbitrage has generated us $1,658 of profit. And this profit is risk-free, given that at 2nd of December 2020 we already know all of the prices that we would have paid and that we would have received, and we also know the risk-free rate that we would have been rewarded for depositing our proceeds. Obviously, these are the 2 cases that are built up on initial hedging considerations, so hedgers can become arbitrageurs on futures markets when there is a favorable condition, plainly if this relationship breaks down significantly in the direction that favors the hedger, so they can beneficially unwind their existing hedges. But if you approach this issue as a pure arbitrageur, so if you have no hedges to start with and you just look at the dynamics of spot and futures markets, you can estimate the possibilities of beneficial arbitrage either way. So for example, a pure arbitrageur would have arbitraged at that stage, given the fact that they had no initial hedges, while here an initial arbitrageur would have actually shorted the spot and longed the futures at that case, given that this difference is quite significant and in the direction that a pure arbitrageur can exploit, unlike our counterparty that had initially a long hedge. And that's all there is for arbitrage on futures markets and how hedges can become arbitrageurs if it is profitable. Please leave a like on this video if you found it helpful. In the comments below, I make to see any further suggestions on videos on business, economics or finance topics you would like me to record. And please don't forget to subscribe to our channel and consider supporting us with Patreon. Thank you very much and stay tuned.